One of the most important aspects of building a high-growth business is raising capital. Even if your business is generating revenue, raising additional capital is almost always necessary to help you fast-track your growth plans. So in addition to your product strategy, your marketing strategy, your people and culture strategy, and all of the other important operational strategies you're using to build your business, it's important for founders to also have a very clear capital strategy. A capital strategy is basically a roadmap for how your startup will fund the things it needs to fuel its growth. A simple way to think about your capital strategy is to work through these questions. First, what is your growth plan over the next 12 to 18 months? Specifically, what are the most important milestones your business needs to achieve in the short term in order to increase its valuation? And what are the initiatives you'll need to fund to get you there? Typically, that would be a combination of things like hiring key team members, further product development, customer acquisition programs, securing commercial partners or distributors, geographic expansion, and other sales and marketing initiatives that are designed to increase customer acquisition, overall revenue, and customer lifetime value. The next question is, how much should you raise? And the answer to that question is generally, raise the amount you need to fund your short-term growth initiatives and execute the identified milestones, plus a buffer. If you're earning revenue, that should be factored in. So once you have your growth plan, you need to estimate the cost of delivering that plan. A cost estimate plus a reasonable contingency is generally the amount you should raise. If you're like most founders, you'll probably want to raise more than you need for lots of reasons. Operationally, you'll want to allow for as many contingencies as possible. We get that. But it's also important to have a very clear rationale for the amount you're raising and why, and be able to demonstrate to potential investors that the proposed use of funds is likely to directly increase the valuation of your business. If you raise more than you need, you may end up diluting your ownership and the ownership of your existing shareholders more than you need to. The next question to consider is the structure of your raise. In other words, should you issue debt, equity, or a hybrid instrument like a convertible note or a safe note? If it's equity, should it be ordinary equity or preference equity? And if it's preference equity, what should the preferential terms be? If it's debt, what should the terms of the debt be? Finally, if you decide to issue equity, you'll need to form a view about the appropriate valuation for your raise. Valuing a business that's in a high growth phase is really more art than science. And because your revenues and profitabilities haven't generally stabilized, valuation methodologies that are used for more advanced businesses, such as discounted cash flow, don't really make sense here. Instead, an acceptable way to set your valuation is based on valuations that have been used by comparable businesses in your sector. By benchmarking your valuation against those of your peers, you're demonstrating to potential investors that the valuation is reasonable because it's based on market-accepted valuations for similar companies. Once you have all that, it's about getting out there and telling your story. And fortunately, today, you can do that digitally and at scale, giving you more options than ever before about how to raise capital and from whom. To find out more, download the new capital raising manifesto on the VentureCrowd website or call us.